Hello and welcome back to the course. In this video, I'm going to take a look at the Fibonacci retracement tool. Now, the Fibonacci retracement tool is based upon a mathematical sequence known as the Fibonacci ratio. I will not go into that here because it's its own subject, but suffice to say that it is a mathematical sequence of numbers that people believe have predictive power, if you will, in the financial markets. And this is based upon the fact that there are ratios of numbers divided into each other that appear time and time again in nature, crop rotations, streams, mountains, you name it. It's pretty fascinating. So I would suggest that perhaps you go look at Fibonacci and just kind of see the science behind it. It is very interesting. But really, when it comes to trading, the most important thing is, does it work? Is it predictive? It doesn't matter if there's some type of mystical power to these numbers. What matters is that people pay attention to them. That's really all I care about. So in front of you, I have a Euro Aussie weekly chart. And you can see the button here on your MetaTrader 4 is the Fibonacci retracement tool. You can see it changes the cursor like that. And to use the Fibonacci, what you do is you start at a swing high or a swing low. So that would be a swing high, that would be a swing low, etc. And you press and hold, and you just drag with your left mouse button, and you can see that it extends various lines. So for example, on this move higher, and once you pulled back, once you could identify that as a swing high, you can see that we have spread out. Now, you see that 100% retracement of this move would be back where we started. Retracing half the move is the 50% right here, 38.2, 23.6, 61.8. Now, in reality, there's really only three that most people pay attention to, 61.8, 50, and 38.2. So what does this mean? This means that traders rallied a bit. They gave back half of the gains and then started buying again. And that's pretty common, really. You'll see that time and time again. Ironically, 50% retracement is not actually a Fibonacci number. It's just a number that a lot of traders over time have employed for their trading decisions, going back decades in the stock markets and such. So, we have this swing high. We bounce from the 50%. That's a pretty strong sign that we could continue. Some traders will then take the next move and then add their Fibonacci retracement there. And what they want to see is a couple of them line up. So if it pulls back to here, that would be the last swing high in 38.2. But somewhere around here, you get a kind of a double. Around here, you get a double, etc. And really, the only thing I can tell you about that is that it just gives you twice as many groups of people looking at different fibs. That's really as interesting as that gets for me. I'll go ahead and switch to the 4-hour chart and see what else we can find. Okay, so this was a swing high, and that was a swing low. So you can see that we pulled back half the distance and started selling off again. Now, you really can't use Fibonacci by itself. Some people will try to tell you you can. I think you're setting yourself up for a lot of trouble by doing so. But for me, what I like to see is a situation where we get a move like that, and that's actually the swing low. So we get a move like that, and we came down to the 50, almost to the 61.8, but notice there's a hammer there. So that gives you a couple of reasons to think, hey, we may go higher. So think of the Fibonacci retracement as a secondary tool. Some people use it as a primary, and they just jump in at 50 or 61.8. I've seen that fail more than once, a little too much for my liking. You are looking for a pullback from a trend. Obviously, the trend's higher there on the daily chart. So that's one of the good things about Fibonacci retracements is it just tells you that, you know, the trend has been going in a particular direction, and we pulled back to offer some value, which is one of the best ways to trade. You know, looking at this, I could also make an argument, I guess. It's going to be a little bit of a stretch here, but for some type of trend line. So, that would have been a candle shape, the 50% and a trend line, as well as the 61.8% holding it right here. I mean, that would have been, a couple different reasons to go along, and that's a perfect Fibonacci trade. As with all things technical analysis related, it's better off on higher time frames. Occasionally you'll see somebody do something really crazy, like try to justify a 5-minute trade based upon a Fibonacci retracement. This wouldn't be the right pair to do that with anyways, but even on a 15-minute chart, you can make an argument, well, the 38.2 held when we pulled back, but really you're kind of reaching there. So stick to the higher time frames with Fibonacci. Use it as a secondary indicator.